All right, so this video, I'm going to talk a little bit about what I'm going to call phase two of the stock market cycle. And to kind of review a little bit, if we go back to sort of my little simplified diagram here of stock market phase in the business cycle, this phase two it would perhaps more normally or more typically be called, the trough in GDP. So this is where we hit the bottom of the economy. So let's just kind of talk a little bit about kind of what's going on in the stock market and what kinds of companies do well and things like that when we're at the trough in terms of the economy. So, brief description here: we are at the bottom of the economy for phase two, or at the trough, and we're after the turn of the stock market. So typically, the stock market has already started going up, in phase one. And companies that typically do well in this phase it's the consumer cyclicals, basically. So as the economy starts to improve, your typical everyday consumer starts to be a little bit more comfortable with his or her job and a little bit more inclined to spend. And there isn't as much concern about, the fact that I'm going to get laid off, for instance. And so as a result, the consumer is a little bit more willing to go out there and spend money. So from that standpoint, the consumer cyclicals tend to do better. So think advertising, airlines, automobile manufacturing and parts, casinos, home construction, home furnishings, media, recreation, restaurants, retailers, footwear, clothing, fabrics. Basically stuff that the consumer is going to spend money on tends to do better here because the consumer starts to get a little bit more engaged in the economy again. And so basically, another characteristic here, or way of characterizing this, would be companies catering to consumer discretionary purchases that are often fueled by credit. So keep in mind, when I'm looking at that phase two environment, the Federal Reserve has lowered rates due to the recession. And so now, since rates are a little bit lower, then credit-fueled purchases tend to look more attractive and tend to look a little bit better. Now, little side note, I can't resist pointing out that hopefully you, as an astute finance student, or a studier of finance would recognize that it's not just the rate at which you are borrowing, but also the price you are paying that matters when making a financing decision. So if the prices are extremely elevated, perhaps for housing, for instance, even if the rate is very low, this may not necessarily be a wise financial choice. So just something to think about. Anyway, so companies that typically do well in this phase are those consumer cyclicals. And the key or driver for this scenario is basically the ongoing or low or possibly still dropping interest rates, but also the continued strengthening of the economy. So we kind of have two things here. So on the one hand, some of these purchases are fueled by credit. So the consumers tend to want to see that those interest rates stay low, maybe even drop further. But also, in order to get that consumer more interested in engaging in economic activity, we really need to see kind of that bottom of the economy and things starting to improve for the consumer to really get engaged in economic activity. So if you think about this, let's go back to that kind of yield curve kind of scenario. So if I think about the yield curve, it's very normal at this point. So interest rates are low. Generally, it's the short-term rates the Federal Reserve has lowered. So typically, very normal looking yield curve, pretty steeply normal, very low short-term rates. General economic conditions here. So unemployment is still kind of high, but once you start getting into late phase two, early phase three, unemployment starts to improve because people start getting more jobs again. So unemployment is still, it's kind of lagging. It's taking a little bit, but the economy is starting to grow. And so when the economy starts to grow, inflation is low. It's not a big concern. Interest rates are low. And basically, the bond market has been going up in value for a while. The stock market turned and started going up. So people's investment accounts are starting to do better. Retirement accounts are starting to look a little bit better. Sort of the proverbial bleeding has stopped a little bit in the investment accounts. There's not as much red ink, right? And so from that perspective, people are starting to feel a little bit better about that. Things like home prices might start to tick upward just a little bit if they were falling. And so the consumer is generally starting to feel a little bit better about his financial situation, a little bit less worried about losing his job. And so all of those kinds of things tend to drive that idea that the consumer might start edging back into this and start spending a bit more. So hopefully this little discussion has been helpful. Thank you so much for watching and have a great day.